Wednesday's US market action was quite interesting. All three major indexes rallied early but gave back gains later. Both the Nasdaq and the S&P 500 ended the day slightly lower. Here's the S&P 500 chart. The three major indexes moved in very similar patterns. They all opened strong with early gains but ended lower, closed in red. Especially the S&P 500 and Nasdaq both spiked first, then pulled back. Ultimately, they closed slightly down. Only the Dow Jones, although it fell, basically ended flat. So overall, was it good or bad? Both the Nasdaq and S&P 500 managed to push to intraday highs. Compared to the previous day, they hit new short-term highs. They briefly broke higher, so they moved one step closer to all-time highs. But was it a good sign? In the end, the market still closed down. It failed to hold its gains. Why did all three indexes show this kind of spark and fade pattern? The main reason was clearly economic data. The CPI numbers were released. Core CPI rose 0.1% month over month, making the fourth straight month below expectations. Year over year, it was up 2.8%, below the 2.9% forecast. This shows that inflation data came in weaker than expected. This broke the market's belief that tariffs would push inflation higher. That assumption failed. Inflation remained soft. This boosted market sentiment. As a result, indexes surged at the open, riding the momentum. There's a clear spike on the bullish data. What's more interesting, Trump officially agreed to the London meeting. It was part of the US-China trade talks. They reached an agreement. This deal was announced almost right after the CPI data, almost immediately, and the market reaction was quite positive. Overall, tariff risks are clearly cooling down. Logically speaking, at this point in time, market sentiment should have been upbeat. And under such optimism, what should have happened? The market should have taken advantage to break above previous highs. No matter what, given all the positives, holding on to gains through the day should have been doable. But instead, why did the market still pull back? Why did it drop? And eventually close slightly lower? It wasn't a big drop, but it did fall. The reason might be rising risks from Iran. Why? Because yesterday in an interview, Trump expressed a growing doubt about talks with Iran. Shortly after, the U.S. State Department announced it would reduce its presence in Iraq. The Pentagon also authorized the military families to voluntarily leave Middle East bases. On the other hand, media also reported that Israeli military has been on high alert recently. Iranian commanders also said they are ready with upgraded missiles for any possible conflict. A major clash could happen anytime, so as this risk escalated, it dragged down the Nasdaq and the S&P 500. In the end, both closed lower. Gold also rebounded at this point. It bounced again. This shows clearly why the Iran risk event led to the pullback in the Nasdaq and the S&P 500. They both gave up earlier gains, a clear reversal. The gold surge confirmed this fear. You can feel it. Whenever geopolitical tensions rise, gold tends to react first. It's a classic risk of asset. It naturally serves as a hedge during uncertainty. So even though trade tensions and tariff fears ease, on the geopolitical front, the pressure remains. Geopolitical risks stay elevated. For example, the Russia-Ukrainian war tensions could still intensify. It's far from over. There's still room for escalation. That's why the market behaved the way it did. Essentially, apart from external risk, the retreat was also driven by technical factors. There was a natural need to pull back after rallying. No follow-through. The S&P 500 and Nasdaq on their own charts, especially on shorter time frames like the 1-hour chart, both showed technical signs of needing a short-term pullback. So the market welcomed it. It was expected. The market was happy to see new highs being tested or even broken, reaching record highs. That's what the investors are hoping for. It's what the market wants. But one thing is clear, technically speaking, while pushing higher, the chart showed divergence. The technical setup wasn't fully supportive. Looking at the MACD indicator during the rally, especially in this section, while prices rose, the MACD did not make a new high. No confirmation from MACD. In fact, it kept trending lower. So this is a clear divergence, and during the rally, the bullish momentum bars on MACD were getting smaller and fewer, shrinking in size, getting weaker, right? Look here, each rally had less bullish strength. Toward the end, momentum nearly vanished, which means as prices pushed higher, the bullish momentum was fading. It was weakening, clearly losing steam. So during a rally, if momentum is weak, continued upside becomes harder to sustain. The move lacks strength, so technically, there is a strong need for short-term correction. A healthy pullback is needed. Therefore, a short-term dip to digest gains and release pressure is healthy. This allows the market to consolidate and gather strength. Then it can rally more steadily. The next breakout would be stronger. But if, despite this divergence, the price is forced higher, that's just pushing it. It's forced and artificial. It lacks conviction. And if that happens, even if it breaks to new highs at that moment, it wouldn't be a solid breakout. The breakdown won't hold. The rally won't be sustainable because there's no strong base underneath. If you push higher without enough momentum, you are moving with weakening energy. That kind of push isn't sustainable. It's like building in midair, no foundation. Even if you break out, the base is weak. It will pull back soon. It might just attack a new high, a small marginal breakout, but at this critical time, it fails to attract a real buying support. In this situation, the move lacks momentum, so even if it breaks out, it's built on a weak base. That limits how far the price can go. Very likely, breaking the previous high will be the last push, exhausting all momentum. And after that, there may not be enough follow through. The market has been waiting for a strong breakout signal, a move to new highs, but for a breakout to hold, it needs sustained follow through, meaning continued capital inflows. It needs momentum. Without that support, even a breakout can quickly pull back. So it might be better now to take time and reset, fix internal issues first. That way, even technical pullback isn't a bad thing. It's not a big problem. In fact, a correction here could give sideline capital a better entry point. So after this short-term adjustment, it might attract new buyers into the market. That wouldn't be a bad outcome. So at this stage, technically speaking, the market does need a pullback. That need is valid. Aside from news headlines, take the Iran situation for example, negotiation tensions were cited as a bearish development for markets. That's somewhat valid, but realistically, the impact shouldn't be too large. It shouldn't cause a major reversal, it's not that big. In my view, yesterday's rally and pullback felt a bit forced. The retreat lacked a conviction, it was shaky, because the upside was clearly backed by a strong catalyst. CPI came in soft, which means inflation is cooling, and that raises the market's rate cut expectations. That's bullish for stocks. Plus, US China trade talks showed real progress, a positive development. That outlook was very encouraging. So, yesterday's rally was justified by solid fundamentals. There were good reasons to push higher, plenty of upside drivers, but then it dropped, and frankly, the reason felt weak. The Iran negotiations and broader regional tensions shouldn't have been enough to cause all three indexes to ease their entire gains. It shouldn't have reversed fully, so this news-driven pullback wasn't a strong enough reason in my view. It just shows that at this level, the Nasdaq had a technical need to correct. So from the 1 hour chart, we could sense that pressure. This kind of pullback is normal and healthy. It provides a better entry point. Funds that hesitated at high levels may now be willing to step in. A pullback gives them that chance, so it's actually a positive, not necessarily a bearish signal. So as for Wednesday's intraday pullback, we can still stay optimistic, remain positive. We still believe the three major indexes have room to move higher. In fact, Nasdaq's attempt at new highs was largely supported by strong tech stocks. In other words, big tech played a key role. For example, the Magnificent Seven performed well earlier. Take Microsoft, it hit a new all-time high, and another key name, Broadcom, also hit a new high. Let me show you. Broadcom still has potential, especially yesterday when the overall market was weak. It actually closed higher and hit a new high again. Despite the weakness, it pushes through and hit new records just like Microsoft. That's worth paying attention to. After a sharp correction earlier, these are the names rebounding fastest. The first to reclaim previous levels. These stocks show real strength. They are outperforming the broader market, breaking new highs ahead of the index. That's a sign of strong independent momentum, very resilient price action. Right now, it's still in a strong bullish trend. The moving averages are aligned upward. It broke above its 1 year average. That breakout came early on, breaking past a key resistance zone, then made a new high, followed by a mild pullback, a healthy dip. It retested that former resistance zone, now acting as support. Successful retest, then resumed upward. This is a clear, strong uptrend, and it may continue. Technically, there are no signs of a clear top forming right now. There aren't any, so this uptrend may continue. The current upward trend could extend further, so at this level, it's a good opportunity to consider entering. Broadcom also shows strong fundamentals. Its strength is clear. Just look at its Q2 earnings, you can see it. Revenue in Q2 rose 20% year over year and nearly flat quarter over quarter. This growth was driven by demand for data centers, visualization software, and cloud products. On top of that, free cash flow surged sharply. It reached $4.6 billion, the highest quarterly level in company history. This jump in free cash flow means that out of $15 billion in Q2 revenue, 42.7% was pure cash that went directly into the bank with no related cash expenses. So, this strong free cash flow in Q2 suggests one thing. Broadcom stock could move even higher. Its fundamentals offer solid support. Both fundamentals and technicals are aligned bullish. That means this upward trend is likely to continue, so it's worth watching. That wraps up our quick analysis of the current US stock market. If you have any thoughts or questions, feel free to leave a comment below.